Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Friday, August 21st, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
So looking at today's data deck, we're really seeing the economy split in two.
Yeah.
Right in front of us. On one side, you have these completely unanchored yields and just massive artificial intelligence spending.
Right.
But then on the other side, the consumer is rapidly cracking.
Yeah, and right in the middle of all that, gold is just totally rewriting the traditional rules of inflation hedging. It's a very specific and frankly pretty challenging economic regime taking hold right now.
Yeah, and the foundation of all this chaos is really the yield curve. We are witnessing a massive hawkish repricing in the rates market today. It's pushed the 30-year Treasury to multi-cycle highs. And to understand why the long end is breaking out like this, we really have to look at what just happened on the front end.
Right, with this morning's U.S. services PMI print.
Yeah.
Because it came in at a blowout 56.8.
Yeah.
But let's break down why a number like 56.8 is causing so much pain today. I mean, generally, a purchasing manager's index reading above 50 means the services sector is expanding, right? So at 56.8, we are looking at the strongest composite business activity reading in over 4 years. If you're a restaurant chain or a travel company, business is booming.
Yeah.
But in the current macro environment, a booming services sector is kind of the last thing the bond market wants to see.
Well, yeah, because the services sector is highly labor intensive.
Right.
Which means strong activity directly translates to sticky wage inflation. So when the bond market sees a 56.8 print, it immediately realizes that central banks they cannot take their foot off the brake. Yeah. The reaction on the front end of the curve was almost instantaneous. The 2-year yield shot up 4.6 basis points to 4.238%. And the implied terminal rate for 2027 has surged to 4.08%. So the entire strip has just transformed.
Yeah, I mean, think about last week. We were tracking modest easing risk.
Right.
And today, the market is pricing a sequence that maintains restrictions straight through the horizon.
Yeah.
And that restrictive pricing is, well, it's acting like a wrecking ball on the back end.
Yeah, it really is.
Because the 30-year Treasury touched 5.32% today. We're talking about the highest level on the 30-year since 2007. And a yield at that level, it fundamentally alters the math for capital allocation across every single asset class. Yeah. Which means the Treasury cannot just sit on its hands.
No, they have to intervene. Which brings us to Secretary Bessent attempting the so-called Treasury twist today.
Right, the Treasury twist. Let's walk through the mechanics of that, because he announced expanded buybacks of longer-dated bonds, right, taking them up to potentially more than $4 billion per issue.
Yeah.
But explain how that's supposed to work simply. Like, why is the Treasury buying back its own long-term debt supposed to lower yields?
So the basic mechanism is just supply and demand. By stepping into the open market and buying back longer-dated bonds, the Treasury removes supply.
Okay.
And reduced supply, assuming demand stays constant, pushes the price of those bonds up.
Right.
And because bond prices and yields move inversely, driving the price up forces the yield down.
Yeah.
So the goal is to artificially suppress long-end interest rates to keep borrowing costs manageable.
Right. So mechanically, that makes sense on paper, but I look at this through a different lens. To me, this sounds exactly like a distressed corporation buying back its own stock just to artificially inflate the share price because management is terrified of a massive sell-off.
Yeah, that's a good way to put it.
And clearly, the bond market saw right through it. I mean, the initial rally on that announcement completely failed today.
Totally.
Yields reversed and finished higher by the close. So if the mechanics dictate that reducing supply lowers yields, the failure of this intervention implies a total breakdown in confidence, right?
Yeah. Institutional investors are viewing this buyback operation as just a temporary technical bandage over a massive structural fiscal deficit.
Right.
The market is looking past the tactical supply reduction and focusing on the underlying reality, which is that the government still has to finance an enormous shortfall.
Yeah.
Buying back bonds today just means they'll have to issue more debt elsewhere. They'll either lean on shorter durations or eventually they'll just have to issue even more long-term debt down the road.
Well, and if if the Treasury shows its hand and acts like an active day trader trying to manage supply, doesn't that inherently signal internal panic about the deficit?
Yes.
I mean, by proving they're worried about the back end of the curve, they essentially validate the exact fears keeping investors awake at night.
Yeah, and that is the exact psychological mechanism driving yields higher right now. The intervention signals that the Treasury sees the 5.3% level on the 30-year as a pain point they just can't ignore.
Mm-hmm.
So when the market realizes the issuer is visibly uncomfortable with its own borrowing costs, it demands a higher term premium.
Right.
Investors are asking for more compensation to hold long-term sovereign debt because the fiscal trajectory looks completely unsustainable. That's why the yield curve remains unanchored.
Yeah, and the pressure from 5.3% long-end yield is exactly what is forcing institutional capital to aggressively rethink their equity positioning.
Yeah.
Because our daily desk data shows hedge funds executing the most aggressive net selling in months. They pulled net leverage down to a one-year low of 48.3%.
That's a huge drop.
Yeah, they are de-risking rapidly. And we're seeing this rotation play out violently in the consumer sector.
Mm-hmm.
Look at Walmart today, ticker WMT. Plunged 9.2% on a soft EPS print.
Yeah.
That is their worst single-day drop since May of 2022.
Well, and Walmart is the ultimate proxy for the health of the average American consumer. So when a massive discount retailer misses on earnings like that, it signals that the consumer is tapped out.
Right.
The discretionary spending budget has evaporated, and shoppers are aggressively trading down.
Yeah, and we always thought of buy now, pay later as the way millennials bought Peloton bikes or, luxury sneakers.
Right.
But our latest run on BNPL debt reveals a terrifying shift. The usage has exploded to encompass 16% of U.S. adults.
Yeah.
But more alarmingly, 20% of those users are financing groceries. And roughly 1/3 of these borrowers are stacking loans across multiple providers just to keep their heads above water. Today, BNPL is being used to buy milk and eggs.
Which is crazy.
Yeah, that isn't a consumer trend. That is a systemic distress signal. The consumer is masking severe financial stress with hidden leverage because real income growth at the bottom of the distribution is just exceptionally weak.
Yeah, and the exhausted consumer represents the bottom end of a severely barbelled economy. Because at the top end, we're tracking major shifts in how the artificial intelligence boom is being financed. Institutional funds are actively reducing their mega cap tech equity exposure. They're pulling back from names like Apple and Micron. But the real story is playing out in the credit markets.
Yeah.
Today's data deck shows $270 billion in investment-grade private placements so far this year.
Which is massive.
It already equals the entire issuance of 2025.
And a massive portion of that is directly tied to the physical build-out of AI infrastructure. I mean, it has gone from 3% of private placements in 2024 to 42% this year.
Yeah.
And these deals are heavily dominated by permanent 144A for life debt structures.
Yeah, and those 144A for life bonds, they lack registration rights, meaning they will never be eligible for major indices.
Right, so structurally smaller buyer base.
Yeah, exactly, and much less liquidity. Yet, credit investors have been absorbing this issuance to fund the physical constraints of AI.
Right.
The power grids, the massive data centers, the advanced cooling systems.
Because in the early days, the hyperscalers used to pay for everything in cash, straight from their pristine balance sheets.
Right.
Now, the AI build-out is so massive, it's like they've maxed out their corporate credit cards and are having to go to private shadow lenders who demand massive interest rates.
Yeah, and that shift from public equity funding to private credit is really altering the risk profile of the entire tech sector. And at the same time, we're seeing a massive institutional rotation into financials.
Yeah.
The institutional consensus is heavily overweighting this sector right now. Robinhood, ticker HOOD, surged 13.7% today.
Yeah.
Coinbase, ticker Coin, was up 8.2%.
Yeah.
And we're also seeing heavy buying in traditional transaction infrastructure. So Capital One, ticker COF, MasterCard, ticker MA, and Visa, ticker V.
Right, because financials benefit mechanically from a steeper yield curve and higher for longer rates.
Yeah.
Banks borrow short and lend long, so a steeper curve expands their net interest margins. Plus, they offer a much lower valuation entry point compared to, the extended tech sector. But looking back at the AI credit data you mentioned, there is a critical warning sign. The private placement premium for technology, media, and telecom is widening sharply.
Right.
Credit investors are suddenly demanding wider spreads and more compensation to finance these AI private placements.
Yeah.
So if bond investors are demanding higher yields to finance these private infrastructure builds, is the bond market acting as the ultimate speed limit on the AI equity rally? I mean, are credit investors finally exhausted by funding these hyperscaler ambitions?
I think so. The credit market is imposing a higher marginal cost of capital on the AI investment boom.
Right.
For the past 2 years, sky-high equity valuations kind of insulated AI development from financing constraints. A tech giant could just issue a little equity to fund a massive server farm.
Yeah.
But now that the build-out requires hundreds of billions in debt, the traditional buyer capacity is becoming saturated. So when the marginal investor demands a higher spread, the cost of building those data centers goes up, which directly compresses the eventual return on invested capital. So yeah, the bond market is essentially setting the speed limit.
Which makes sense. And this aggressive equity rotation, the cracking consumer at Walmart, the failure of the Treasury's bond buyback, all of this is driving capital toward pure shelter. We are seeing historic rallies in hard assets. Gold surged 1.9% today to over $4,600 an ounce.
Yeah.
And Bitcoin spiked 23% on the week to around $77,000.
Yeah. And we're also tracking heavy moves across the broader commodity complex. Brent crude rallied over 7% to roughly $93.50 a barrel based on direct geopolitical escalation in the Middle East.
Right.
Meanwhile, industrial metals caught a massive bid. Aluminum surged nearly 5%, and copper climbed 1.5% following China's announcement of new fiscal support measures targeted at the second half of the year.
Which is interesting because the metals pricing requires us to challenge traditional macroeconomic rules here.
Yeah.
Today, the 10-year TPS real yield rose to 2.405%. And a TPS is a Treasury inflation-protected security, meaning that 2.405% is your risk-free return after accounting for inflation. Right.
Historically, rising real yields crush non-yielding assets like gold. You can earn a guaranteed real return in government bonds, so the opportunity cost of holding a bar of gold sitting in a vault goes up.
Yeah.
Mechanically, gold should be selling off right now. Why is gold completely ignoring rising real yields?
Because the historical correlation has broken entirely. We're operating in a new regime where the debasement trade is overriding traditional rate mechanics.
Okay.
Investors are treating gold and increasingly Bitcoin as sovereign risk hedges. When the market looks at a 5.3% yield on the 30-year Treasury and watches a failed buyback operation, they see a government that cannot structurally contain its deficit.
Right, so they're hedging against the currency itself because the math on the fiscal deficit just does not work without aggressive debasement.
Exactly. They're hedging against the eventual monetization of that debt.
Yeah.
If the market believes the only mathematical way out of a spiraling deficit is for the central bank to step in and debase the currency, the nominal level of real yields ceases to matter.
The capital is seeking assets completely outside the sovereign financial system. That's why gold is pushing past $4,600 an ounce in the face of highly restrictive central bank policy.
Pulling this all together, our latest run reveals a market pricing in a very specific, highly challenging economic regime, a stagflationary barbell.
Yeah.
Stagflation is, of course, the toxic combination of stagnant economic growth and high inflation, and the barbell describes how different sectors are surviving it.
Right. Because on one side of the barbell, we have immense capital flowing into AI, physical infrastructure, and highly profitable financials. These are sectors that either have massive, multi-decade secular growth tailwinds, or they directly benefit from a steeper yield curve and higher rates.
But on the other side of that barbell, the lowest tier corporate credit is flashing bright red.
Yeah.
Today's proprietary updates show CCC high-yield spreads blowing out by 151 basis points to hit 852 basis points.
Which is severe.
Yeah. That spread blowout signals acute distress and rising default probabilities for low-rated, highly levered companies. But at the exact same time, BB spreads are actually tightening.
Right. And that massive divergence between CCC and BB credit is the textbook definition of the barbell.
Yeah.
The strong services data we saw this morning is keeping rates restrictive. Those restrictive rates are crushing the low-income consumer, which we clearly see in the Walmart EPS miss and the explosion of buy now, pay later debt being used for basic groceries.
Right.
Those same restrictive rates are bankrupting bottom-tier corporations that rely on floating rate debt, driving the CCC spread blowout.
Meanwhile, the top end of the market is insulating itself. Institutional capital is rotating into hard assets like gold and crypto to avoid sovereign risk, or moving into specialized private credit to capture the high yield from the AI infrastructure build-out.
Yeah.
The middle of the economy is just completely hollowed out.
It really is. The macro environment has become brutally unforgiving for anyone dependent on cheap debt or low-end consumer spending. At the same time, vast fortunes are being deployed to build the physical architecture of the next technological era, and it's happening largely outside the traditional public equity indices.
Which leaves us with a critical question to ponder over the weekend regarding this unprecedented AI boom. We are tracking AI capital expenditures hitting $1 to $1.5 trillion annually. The funding mechanism has shifted away from the pristine balance sheets of the hyperscalers and into complex, illiquid debt vehicles like 144A for life private placements.
Right.
So if the credit markets reach their absorption capacity and the cost of capital continues to rise, the math on those data centers changes rapidly.
Yeah.
Who ultimately bears the systemic financing risk if those massive AI returns don't materialize on the timeline that debt markets expect?
It's a huge question, and just to quickly recap today's core takeaways, we are watching a severe yield curve steepening driven by unanchored long-end rates and a failed Treasury intervention.
Right.
We have a rapidly cracking low-end consumer, contrasting sharply with massive AI infrastructure spending. And we are seeing the debasement trade push hard assets like gold and crypto to historic highs in direct defiance of rising real yields.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back next week with the latest market color. Have a great weekend.